So today is Saturday, August the 17th, and in Thursday's video I talked about putting on a vertical call spread for Walmart, and somebody asked me to go into more detail on that. First of all, what were the reasons why I would want to trade Walmart in any case? Well, Wednesday they had earnings and they were good. Thursday I went into a Walmart store and to buy some tennis balls, and the place was pretty busy. If there's any concern about a recession or the consumers lose confidence, it's typically to the lower spending places they go. And some friends of mine actually told me over dinner one night that they actually buy packaged goods there and personal body supplies and so on. So I've got other places that I like to shop that are discount, like Trader Joe's, Lidl, and Aldi. And I don't normally go into Walmart, but I was surprised, and I think that it could be a good play. Now, I took a look at a chart. This is a weekly chart going back to 2016, and I drew what was called a Fibonacci Expansion. So I looked at this low point in 2007, this high point in 2015, and I drew my first point here, my second point there. I'll show you how that actually works. So let's just delete this and let's go into Fibonacci Expansion, and let's take this low point here, this high point here, and then this low point, and say if I peg it right here, if from this point the stock is going to repeat this wave, what does it look like? Where will the breaks be in the Fibonacci? Now let's expand this a little bit. And you can look and see where things fall out. So this 23.6, I'm not crazy about 23.6, but 38.2 is really important. And look, if someone had drawn this way back in November, they would have set a target at 74.89, and they would have hit it. And they could have taken some off and waited for a pullback. And depending on when they felt comfortable getting back in, the Fibonacci say it's next going to go to 80.63. And it did. And it pulled back. And it went again. And then it churned around. Where was the next target going to be? Well, it didn't take long. It only took 1 week, but it went up to 61.8% in that 1 week. Where's the next target? 78.6. And you can see that had this been drawn back in October of 2015, it's very reliable. And 100%, or a move equal to the last move up that ended at 90.97, would have finished at 104.96. And in this particular week, it did perfectly. It shot over it the following week, but there weren't enough buyers to keep it there, so it dropped back down. And where did it come back down to? 50%. So anybody who bought in this area here is still a winner, even though it's pulled back to 50%. And then where did it go to? 88.7, 78.6, back to 100, pullback. Where is it going next? Because these Fibonacci's have been so darn accurate, and we did hit 114.6. It's a minor Fibonacci. I don't normally like to look at it. 123.6 is another minor Fibonacci. I'm not crazy about that one, but 127.2 is where expansions typically go, 118. So those two factors, what I saw, three factors, their earnings, what I saw in visiting a Walmart store, and these Fibonacci's lead me to a confidence that it's going to move from 105 up to 118, and is currently trading at 113. But in what time frame? So when you're playing with options, you need to be fairly certain about what time frame your expectations are going to fall in. You don't want to have it too long out. You end up paying a lot more for something. You don't want to have it too soon because it's just not going to happen maybe as soon as you'd like it to. So you pick something in the middle. So I picked something 5 weeks out. I could have gone a little bit further, but the options that I wanted, 115 and 117, the 117 isn't available on every expiration. So I had to find one that had the 117 in it because I didn't want to go 115 to 120. If I did, using round numbers like that, I could have picked any options expiration I wanted. I wanted 115 and 117. So I went into my TD Ameritrade trading platform. You can download this for free from TD Ameritrade, and you can go and set up a paper trading account, and you can learn. You can use it to study different call and put combinations. I'm only going to talk about vertical calls today because they are the least risky of all the things you can do in trading options. If you buy a call, the most you can lose is what you pay. If you sell a call, the most you can lose is everything. And I won't explain that other than to say that if you don't have experience or you don't have enough money in your account, your trading platform is not going to let you sell calls all alone. If you buy a put, the most you can lose is what you paid for the put. If you sell a put, the most you can lose is everything. So with that in mind, whenever you buy something in options, the most you can lose is what you paid. So you know what your risk is up front. If you can afford to lose $700, which this blue line shows you on September the 28th, if the price ends below 114.85, I'm going to lose $700. I'm going to break even if on September the 28th the price is 115.69. But if the price can get up to 117.24 by the end of September, I'll have doubled my money. Instead of losing or paying $700, I'll make $1,300. Am I going to hold it this long? No, I am not. This pink curve shows you how that options combination is going to play out on a daily basis. So as the stock price moves up on this day, today is Saturday, of course we're not trading Saturday, so let's go into Monday. Let's change the date to the 19th. What's it going to look like on the 19th? Well, the current price is right here, 112.99. If the stock jumps to 114.85, this shows that I will have made, look down here in this corner here, I will have made $255. Let's go out a week. And let's say instead of the 16th, oh sorry, I've got it down to 16th, do I? Let's look at it on the 23rd. So on August the 23rd, or 24th, if we end up at 114.85, I'll have made that pink number down in the left, 243. Let's take it out another week further. What if we go out to August the 30th? If on August the 30th we're at 116, I'll have made $381. So this line is going to start to approximate the blue line as every day goes by, and time value, I'm not going to explain that, but time value erodes out of those options. There are 4 factors that make up option pricing. Time is the theta value. So as time goes on, watch how this curve changes. Let me go back down to the calendar. Watch. I'm just going to click updates. See how the curve is changing? You're getting closer and closer to the blue line. So that on September the 23rd, we're very close. Let's go back to today. Well, let's not. Let's go back to, maybe after Labor Day. I want to make 50% of my money. I don't need to double it. if I put in 700 and I could take out 1,000, I would be happy. So when I get to 1,000, and it's not going to be until 121.47, just after Labor Day, but if it gets there sooner, let's look at something like the 20th, I could get to $1,000. Ooh, it's going to have to get to 123. But I'm just going to watch my spread, and when I have made my money back, 700, then I'm going to look at when I'm going to walk out with my profit. Am I going to keep it till September the 23rd? Maybe, maybe not. But that's my choice. I can get out anytime I want. If my maximum risk for losing is $200, and that happens and it goes down to 110 on Monday, then I've lost $193. I can close my spread in the opposite way that I bought it. And the way you buy a vertical spread is, let's take a simulated trade. Let's go back out to this one here. Let's say that I wanted to do a 112 and 114. So I would buy the 112. I click on buy. Where's my order? There's my buy. Go back to my, and I would right click and or press the control key and sell. So now here's my spread. I've bought a 112 and I've sold a 114 expiring on the 27th of September, but I paid $1.88 for that. I only paid 70 cents for the spread that I put on. So that's too rich because we're already at and above 112. So if you want to lower your cost, you have to put on a bit more risk. So then you would go out to buying the 115 and selling the 117. That's now a 76 cent debit. I paid 70 cents. If I want to spread that, I could go out to 120. I would pay $1.43. A little bit too rich for my blood, but let's see what the return on that would be. Let's go back to the risk profile. Let's turn off the options that we have. And this one contract of buying the 115 and selling the 120 can lose $143, right? 100 times $1.43. The most it can make is $357. Not bad. So if I'm ready to lose $143, I could make $357. The most I can ever lose is $143. Don't care what you say. The most I can ever lose is $143. If the price drops to $97 tomorrow, I'll have lost $143. Over. And I can get out of my trade. I can never lose more than what I paid, unless the options makers make it difficult for people in losing trades to get out. Then you might lose 150, 160 because they've created a bigger spread on it. But if you do nothing, you've lost your $143, do nothing. Keep the damn things on. It may show that you're losing 160, but just wait. Keep it on till the end of September. You can't lose any more. And you'll see that as time goes by, you'll come back to your 143, and who knows, the stock may turn around again, and you may have an opportunity to get back and actually make a little bit of money. I hope that was easy to explain. I'm not going to explain the opposite, which is selling a call vertical, because you can lose a lot of money. I'm not going to explain selling a put vertical, which would have the same risk-reward shape. Let's not get into that. Let's just stick with call verticals. If I ever do something different, and I often do, I'll put out a video on that. I'm sorry this took so long, but I hope it was helpful.